You might lose some money if you believe these falsehoods. These fallacies deter stock market investing. They miss a good investment opportunity. In the early stock market, investing was harder. Many things are no longer true, and some facts are now myths. To avoid myths, review them. Here are the 13 biggest stock market myths. Number 1. Beat the market easily. Many feel they can beat market returns. They think so since certain investors and fund managers beat the market for years. When compared to the market, none of the active funds outperformed in the long run. Most active funds dramatically underperformed the market over time. This is the main reason passive investing is so popular. Instead of picking winning stocks, you invest in the market. That's also risky. You must still research. You must choose an index to invest in. This guarantees market returns minus fees. Reduce these fees. Stock pickers are smart. Vanguard founder John Bogle calls them pricey. Number 2. Bonds never fail. Many assume bonds are completely safe. Yet, this is untrue. Stock may be riskier. Bonds can be riskier than stocks. Bonds are confusing to most individuals. Consumers comprehend yield but not valuation. Bonds offer a fixed interest rate. Keep the bond until maturity to get your capital back plus interest. Yet, a firm may default on its bond. Government bonds rarely default, although they can. Default rarely yields anything. Number 3. Invest in hot things. Investing in what's trending is another long-standing myth. Follow the crowd. Yet, following the crowd is one of the biggest stock market blunders. This method has some drawbacks. Early investors may profit. All followers are late in the game. This reduces stock returns. The crowd typically drives the stock price crazy. Most of them didn't analyze the stock and think it will always rise. Early investors selling lowers the price. Investors panic and sell rapidly. This accelerates a stock market correction. Never follow others. Avoid financial advice and do your own research. Number 4. Investing takes genius. Many people think they're too stupid to invest in stocks. They assume geniuses invest in stocks. Old myth. Still a myth. Stock market investing does not require genius. Control your emotions. Emotions are a bigger investment issue than intelligence. Investing in a large indices like a country's index doesn't require much intelligence. Naturally, don't overspend. Don't sell at the first loss. Age also contributes to this notion. Some assume they're too young or old to invest in stocks. Age does not affect stock market success. Number 5. Good companies always have good stock. Avoid this deadly myth. Good companies have good stocks. One major exception exists. Stocks can be overpriced. Many technology equities during the dot-com bubble were the best example. Microsoft fell 50% after the dot-com crash. The stock reached dot-com levels after 15 years. Microsoft kept earning more. VeriSign is another insane case. The dot-com meltdown reduced its stock price from $250 to $10. Since then, the stock hasn't recovered. 6. Stocks usually rise. Invest in the stock market because it constantly rises. The stock market always rose over time. The market dropped over 10% multiple times. Stock market investors must expect significant drops. The stock market drops 10% annually and 20% every 4 years. Expect a 30% drop every decade. Number 7. Riskier yields more. The fallacy that increased risk equals higher profits makes reasonable at first. Nevertheless, risk does not always equal return. Discussing stock risk. It works in principle but not in practice. Low-risk stocks consistently outperform high-risk ones over the long haul. Consider the world's top investors. Warren Buffett's portfolio is risk-free. You'll find undervalued items with tremendous worth. Number 8. IPO makes you rich. IPOs have increased in recent years. Every IPO is thought to return a lot. That's a myth. That myth fails because most IPOs succeed. Failed IPOs are rarely discussed. IPOs fail more than succeed. Uber's IPO delighted everyone. The IPO opened at $45 but closed at $38. Uber regained its IPO price after a month in a rising market. IPOs often overvalue. IPO prices often exceed business value. Number 10. Down stocks rise. This myth has always been around. Some investors invest extensively in a falling stock because they assume it will rise. They think it will keep rising because it did before. Now, some stocks will indeed recover. A falling good stock may be worth more. A terrible stock falling may signal a direct slope without recovery. Nothing suggests a good stock was not expensive earlier. Thus, there is absolutely no certainty that a stock going down will go up again. Number 11. Market drops cost money. This fallacy is all over the news and the media. Every media will declare people lost 10% of their money if the stock market declines 10%. They will say that people lost billions of dollars. This is false. Market declines don't cost you. The shares that you have in the market are worth less following the dip. That is true. Yet, if you do not sell them, you have not lost any money. You can only lose money on the market if you sell some shares. Save your shares for a rebound. Number 12. A highly valued stock will go down. The next myth is almost the opposite. Some individuals assume that a price that is going up a lot has to go down at some point. They are waiting for the dip to invest. This is pure market timing. Yet, this is far from being accurate. Several stocks have been going up for a long time now without displaying any hint of downturn. Walmart stock has been growing for years. It dropped down with the market corrections and recessions but did not suffer a correction of its own. 13. Investment is gambling. Like gambling, investing is risky for some. Single stock investments are risky. If you invest in a good company, you still have higher odds than playing against the house. Investing in a dodgy firm is like gambling, but investing in the larger market is not that risky. Long-term returns are great, yet this is all part of investing. We hope this video was educational. Subscribe to our channel and hit the notification bell for more.